What triggered Venezuela's economic crisis? Have you ever wondered how a country rich in resources can face such a severe economic crisis? Let's break down what happened in Venezuela. The roots of Venezuela's economic crisis can be traced back to the late 1990s when Hugo Chávez became president. He introduced socialist economic policies that changed the entire landscape of the economy. One of the first major moves was the nationalization of key industries, including oil and agriculture. This shift removed the profit motive that drives efficiency in a capitalist economy. As a result, production levels began to plummet. The government took over these industries without the necessary expertise to manage them effectively. This led to a significant decline in economic output. Alongside nationalization, the government imposed strict currency and price controls. These measures distorted market signals, causing shortages of basic goods like food and medicine. Investment in the country also took a hit due to these controls. The government relied heavily on oil revenues to fund expansive welfare programs. However, when global oil prices fell sharply around 2014, Venezuela faced a massive financial crisis. The economy, which depended almost entirely on oil exports, could not sustain itself without sufficient foreign currency reserves. Instead of reforming the policies, the government doubled down on interventionist strategies. They maintained currency controls and continued to allocate scarce dollars at subsidized rates to political allies. This approach only deepened economic inefficiencies and corruption. The collapse of import capacity led to a severe recession, hyperinflation, and widespread shortages of essential goods. While some point to external factors like United States sanctions, these were not the root causes of the crisis. They merely exacerbated an already failing economy. The real issue lay in the socialist policies that dismantled private property rights and market mechanisms. From a capitalist viewpoint, Venezuela's crisis serves as a warning about the dangers of excessive government control over the economy. The elimination of market incentives and economic freedoms can lead to dire consequences. The Venezuelan situation illustrates how replacing market-driven capitalism with centralized planning can result in economic ruin and social collapse. Understanding these factors can help us learn from Venezuela's experience and the importance of balancing economic systems for sustainable growth.